Hi, I'm Ant Joblin from the Investing Channel and welcome to The Juice. As the Fed takes centre stage, all eyes turn to the bond market and the latest scuttlebutt revolves around the dreaded yield curve. So, for those of you that fell asleep in Finance 101, the yield curve represents the interest rates across US Treasury debt of different durations. Normally, the longer we have until the bond's maturity, i.e. the expiration date, the higher the interest rate. Sometimes the curve flips around, and that is known as the inverted yield curve. Historically, this happens when investors expect inflation short term, but more importantly, many believe that the inversion precedes a recession, and that's what the fear is right now. Also, banks rely on a steep yield curve to make their profits, and flat or inverted yield curves hurt them. So, where are we at? Well, if we take a look at the current US Treasury yield curve, we can see that the rates for the 2-year, 10-year have increased, and the spread between the 5-year yield and the 30-year yield has also contracted. And while the inverted yield curve did precede the recession of 2020, it's hard to tie those together with COVID in the mix. So, what should we expect? Well, with the Fed set to announce the start of tapering next week, the shorter duration bonds are likely to sell off. That means yields will jump up on short-term treasuries, putting pressure on banks. The good news is that this means your savings account, yes, should pay more. Getting to the bottom line, we don't need to watch the yield curve every day, but keep it in the back of your mind. If we see yields on maturities less than 1 year start to rise, that's when you start to worry. Until then, keep with your current strategy. That's all we have time for today on The Juice. Click follow and subscribe to The Juice email for your daily dose of market minerals.